Good morning students. Today we will learn the types of companies. Classification of companies. Now the companies are classified according to different modes. The first one is according to mode of incorporation. It can be classified in the following kinds. The first one is chartered company. Companies which are established by royal charter or under special order granted by king or queen is known as chartered companies. Such companies can be set up only in countries having system of monarchy. The examples are East India Company, Bank of England, Chartered Bank of Australia, India and China. The Hudson Bay Company are the examples of chartered company. We don't find such kind of company now in India, so the chartered companies are established by royal, king or queen who are known as chartered companies. Second one, statutory company. Now the word statutory itself means passed by law. Such companies is established under special act passed by parliament or state legislature. The object and power of such company is defined by the act. Therefore, such company is not required to have memorandum of association. Now, in the coming chapters, we will be learning what is memorandum of association and articles of association. Statutory company need not to use word limited against its name. The audit of statutory company corporation is conducted under supervision and control of Comptroller and Auditor General. Statutory companies generally enjoy autonomous status as they are created to carry out business requiring extraordinary powers and privileges. So, the statutory companies are created under the act of the parliament or state legislature, and it does not add the word limited with its name, and somehow it has got an autonomy. Autonomy means freedom of conducting the business. They have got extra power, like the government does not overrule the power, and so the extra powers and privileges are given to these statutory companies. The examples are Reserve Bank of India, Industrial Development Bank of India, Life Insurance Company of India. So even though they are under the government, passed through the parliament, but still they enjoy some autonomy or freedom in carrying out the business with some powers and privileges. A joint stock company can be several kinds as seen from the following charts. So here you can see mode of incorporation: chartered, statutory, registered or incorporated. Liability: unlimited, limited by shares, limited by guarantee. Public interest: public, private, one person. Ownership and control: holding, subsidiary, government. Nationality or jurisdiction: Indian, foreign and multinational. So we have gone through the two of the types of companies with the mode of incorporation. So here you can see here chartered and statutory already we saw. Now we will see registered or incorporated company. A company registered under the Companies Act is called registered or incorporated company. Such companies are most common in practice. In this book, all reference to company relate to registered company unless otherwise stated. So in this book we are going through learning about the registered company. So whichever companies we went through till now, in the previous chapters we have learned about the registered companies. It is significant to note that insurance, banking, electricity supply companies are all incorporated under Companies Act, but their operations are governed by provision of their special act named Insurance Act 1938, Banking Regulation Act 1949 and the Electricity Supply Act 1949. So all the insurance, banking, electricity companies are registered, are incorporated under the Companies Act, but separately they act as per their special act, like insurance company with Insurance Act 1938, banking company, Banking Regulation Act 1949, Electricity Supply Act 1949, which supplies electricity. So here we have the provisions of the Companies Act are applicable to these companies only to the extent that they are not inconsistent with those contained with the special statutes governing them. SAIL, Reliance Industry Limited, Maruti Udyog are examples of registered company. Now registered companies are again of three types: company limited by shares, company limited by guarantee, company unlimited liability company. On the basis of liability of members, company can be divided into three categories. Company limited by shares. In this type of company, the liability of members. Now we know what is the liability, what the company has to owe to others. So the liability of the members is limited to the face value of the share, and the person is not asked to give further any liability to the company, only till the face value of the shares. In case of partly paid shares, of the liability of members is limited to the unpaid amount on the shares held by them. In India, most of the company belong to this category. So now if any shares are unpaid, so the liability will be limited only to the unpaid amount. Number B, company limited by guarantee. In such company, the liability of members is limited to such amount as they agree to contribute to the assets of the company in event of its being wound up. This amount is known as guarantee, and it is stated in the memorandum of association. So here company limited by guarantee is limited to what they agree to contribute to the assets of the company. Okay, like the amount of guaranteed by the members can be called up only at the time of winding up. So whenever the company is winding up or closing down, that is the time the guarantee can be called. The amount guaranteed by the members can be called up at the time of winding up. It is therefore in the nature of reserve capital. Such a company may or may not have share capital. In case company has share capital, liability of its member consists of, beside the guarantee, the unpaid amount. If any of the shares held by them, a guarantee company is formed generally to promote education, arts, science, culture, sports, etc. Trade association, chambers of commerce, stock exchange, sport clubs are often organized as companies limited by guarantee. The article of association of such company must state the number of members with which the company is to be registered. So company limited by guarantee, they are limited to the amount they agree to contribute as asset, and this guarantee is stated in the memorandum of association, and in the articles of association the number of members are stated, and the members are called up for the guaranteed amount only at the time of winding up. Not for profits company. Section 25, companies are usually set up to promote commerce, art, science, religion, philanthropy or any other useful public objectives, and have to deploy profit or other income to further these aims. So here not for profit under section 25 is the companies which are open to promote commerce, art, science, religion and other useful public objectives, and not for profit. Number C, under the registered on the basis of liability of the members, number C, we have unlimited liability company. It is the company in which liability of every member is unlimited to its personal property. In this type of company, the members are personally liable to pay debts of the company in proportion of their interest. Such company or may not have share capital, but the creditors of such company cannot sue the members directly. So here the members of the unlimited company, their liabilities are unlimited to the extent of their personal properties, and they personally are liable to pay the debts, but here the creditors are the one to whom the debts will be paid. They cannot directly catch up or sue the members directly. the liability of a member is enforceable only at the time of winding up of the company. Now, the creditors, they simply cannot charge, or they simply cannot put a case on the members of the company for the liability. Only at the time of winding up, then only the liability of the member is enforceable. The Companies Act 2013 provides for incorporation of a company having no limit on the liability of its member, but this is very rarely found in practice. So we have gone through on the basis of incorporation. Now on the basis of ownership and control, companies are of following types: holding company, subsidiary company, and government company. So holding company, it is any company which directly or indirectly through medium of another company either holds more than half of equity share capital of another company. Now equity share capital is the share capital which is divided into different number of shares. So any company either directly or indirectly or through the medium of any other company holds or purchases half of the equity share of another company or controls the composition of board of directors of other company, then it becomes a holding company. So here the holding company of other company may be either be of three ways. Number A, by holding more than 50% of equity capital of the other company, by holding more than 50% of the voting rights of other company, by holding the right to appoint majority of directors in the company. So they have the equity capital 50% more of other company, they have voting right 50% more of other company, or they have the board of directors, the composition is 50% and more in the other company. Now we have subsidiary company. It is a company in which another company called holding company. Now it is opposite. In holding company, you are holding the other company, your company. Okay. In subsidiary company, the other company is holding your company. So it is opposite. So holds more than 50% of total share capital or more than 50% of voting rights, controls composition of its board of directors with the sole purpose of controlling its management, is the subsidiary of another subsidiary company. So ownership, the holding company is holding other company, subsidiary is been held by another company. In the words of Gertzben, any company owned or controlled by another company to the extent to its mere instrument to carry out orders of the owning company is called subsidiary company. Number 3, government company. It is a company in which 51% or more of the paid up share capital is held by the central government and or by one or more state government. It may be partly or wholly owned by the government. So government company is in which 50% or more of the paid up share is held by the central or state government, or partly or wholly, completely owned by the government. A company which is subsidiary of government company is also considered to be government company. A government company are also registered under Companies Act. Generally, public enterprise which undertake industrial and commercial activities are established as government companies. Steel Authority of India, Bharat Heavy Electrical Limited, Hindustan Machine Tools Limited, State Trading Corporation of India are examples of government company. So government company are when the government, state or central government holds 51% share of the other company or complete share of the other company. Next we have on the basis of nationality or jurisdiction. We have Indian company, foreign company and multinational company. Indian company, a company which is incorporated in India. It is registered under the provision of Indian Companies Act. It is registered in the office in India, though the business is carried out outside India. Foreign company means any company or body corporate incorporated outside India, has place of business in India, whether it is through agent, physically or electronic mode, conducts any business activity in India, but it is incorporated and registered outside India. it must conspicuously exhibit on the outside of every office or place where it carries on the business in India, the name of the company and the country in which it is incorporated in English and in one of the local languages. In case 51% or more of the paid-up share capital of the foreign company is held by one or more citizens of India and one or more bodies corporate incorporated in India, such a company shall comply with the prescribed formalities with regard to a business carried on in India as if it were a company incorporated in India. Every foreign company must file the following documents within 30 days establishing its business in India. So, the company which is registered outside carrying the business in India, every office should have the name of the place, name of the company, country where it is registered, both in English and local language. In case of 51% or more of the paid-up share capital of the foreign company is held by one or more citizens of India and one or more body corporate incorporated in India, such company can comply with prescribed formalities with regard to business, and within 30 days following documents has to be submitted: certified copies of memorandum and article, full address of its registered office, full particulars of its director and secretary, name and address of its authorized representatives in India, full address of its principal place of business in India. The third one is multinational company. A company which has production of marketing facilities in several countries is called multinational. Its ownership and management are controlled and control are spread over in 2 or more countries. We will be going through explanation of this in the coming chapters: branches, franchisee, turnkey projects, joint ventures, subsidiary companies. These are the examples of Pepsi, Coca-Cola, Bata are the examples of multinational company. So the multinational company production and marketing is done in 2 or more countries, is spread out on the basis of public interest or transferability of shares. The first one is private, public, and we have here OPC. Okay. Private. It means the company which has minimum paid up capital of 1 lakh or such higher paid up capital as may be prescribed, and which by its article of association restrict the right of members to transfer shares. So in private company, the members cannot transfer the shares. Number B, except in case of one person company limits the number of members to 200, excluding members who are or were in the employment of the company. Number C, prohibits any invitation to public to subscribe for any security of company. Number D, prohibits any invitation or acceptance of deposit from the person other than its members of the directors. So the private company has minimum paid up capital of 1 lakh or more or such higher paid up capital, and as per the article of association, the right of members to transfer shares is restricted. Limited member is 200. It prohibits any invitation to public to subscribe for any shares or to invite for the acceptance of any money for the shares, and the minimum number is 2. Such company must use the word private. A private company enjoys special privileges and exemptions from Company Act. Public company. It means a company which is not private. It has minimum paid up capital of 5 lakhs. Is a private company which subsidiary of a company. Is a private company which is subsidiary of a company which is not a private company. So if any company which is subsidiary of another company, it will not be counted as a private company if it is a subsidiary of a public company. Thus, public company is one which does not restrict transfer of shares, does not limit the number of members, can invite general public to subscribe shares, can invite or accept deposits from the public. And minimum here is 7%. Okay, so here Other one is OPC. OPC means one person company. The Company Act 2013 allows the formation of one person company. Now the sole traders, they are the single-handed business personals, but they cannot expand the business. So the Company Act 2013, they gave the power to one person who can run business in expanded form. As name suggests, a one-person company has only one member. The company's name will carry a suffix OPC. The process of setting upon OPC is the same as private limited company. Since company is owned by a single person, he must nominate someone to take charge of it in case of death or disability. So here the sole trader was, if the owner dies, the business is closed down. But according to the Companies Act 2013, they came with a suggestion of OPC, one person company, which will function as a private limited company, and since the name is one person, it will be run by one person, but in case of death or disability, that single person can nominate someone else to carry on the business. The nominee, the person whom he is electing to carry on the business, the nominee must give his consent in writing, which has to be filed with registrar of company. An OPC is exempt from certain procedural formalities such as conducting annual general meetings and extraordinary general meetings. No provisions have been prescribed on holding board meetings if there is only one director, but 2 meetings need to be organized every year if there is more than one director. Any resolution passed by the sole members must be communicated to the company and entered in the minutes book. There is, however, no relief from provision of audits, financial statement, accounts which are applicable to private company. So the one person company is exempted from certain formalities like annual general meeting, extraordinary general meeting. They have no provision has been prescribed on holding board meetings if there is only one directors, but if there is more than 2 directors or more than one directors, then at least 2 meetings has to be organized every year, and any resolution passed by the sole member must be communicated to the company and it should be entered in the minutes book. Now minutes book is like a book where the meetings are being registered, the details and the list of the meeting, what was the talk of the meeting, what was the outcome of the meeting. So everything is been recorded in the minutes. So it has to be recorded, but there is no relief for the audit of the financial and accounting statement. Now, what are the benefits and drawbacks of OPC? The biggest advantage of one person company is that it identifies it. The biggest advantage of one person company is that its identity is distinct from its owner. Therefore, if the company is embroiled in a legal controversy, the owner will not be sued. So, here as according to the company, the owner and the company becomes separate. It is not like a sole trader. So if there is any kind of controversy or any case, the owner will not be sued, the company will be sued. The another advantage is limited liability. Since the company is distinct from its owner, the personal assets of the shareholder and directors remain protected in case of credit default. So only the company will repay the liability. The owner's property will not be touched. It will remain protected. On the other hand, OPC is not easy to set up. It requires lots of paperwork and is time consuming and costly process. So this is the disadvantage. Despite the advantage that one person company offers, it may not be viable option for everyone. In contrast to a company, a proprietorship is easy to set up. The paperwork involved is minimal. Of course, the risk of proprietorship is higher as the owner is personally responsible for the business. So today we have gone through the types of company according to the different bases, and you go through this and we'll continue in the next class.